All right. Thanks everybody for joining. We got our digital asset panel here at Columbia Business School. We are gonna just chat about a few different things before I even get going and introduce the panelists. I'm gonna read off a bit of a disclaimer just to make sure that everybody's butt is covered and they can just talk about everything they want to talk about. So the content that we discuss today should not be construed as investment advice. Everything we say is for information and entertainment purposes only. For anything you find interesting and actionable, make sure you do your own due diligence. And the comments of the panelists represent their own views and not necessarily the views of the firms that they work for or Columbia Business School. With that said, I'll go ahead and introduce our panelists for today. I'll give a brief background about them, and then we'll ask them the first question of the day, which is, how'd you get into crypto? So why don't we get started with Austin? He's on the top of my screen here, so we'll get started with him. So Austin went to Lawrence University. Before getting into crypto, he worked and did a bit of digital content and marketing. Then he bounced around through various different firms, including Republic, and now he's the head of communications at Solana Labs, one of the prime layer one solutions out there today. And thank you, Austin, for taking the time to be here. So why don't you tell us, how'd you get into crypto?
I joined a failing fintech company in early 2017 that was in a desperate move to pivot to blockchain. They were trying to do factoring and lending for gig economy workers. And obviously I wasn't aware this was a failing company at the time that I joined, but they were on a mission to try and get a borrow lend protocol going up on Ethereum before DeFi was like really properly a thing. So that was my introduction into it. The company, crashed and burned 2 months later, and I joined Republic, where I ran marketing for Republic and Republic Crypto, which was basically a non-accredited version of AngelList that was also doing token pre-sales back at the time. So that was my trial by fire into crypto.
Got it. Awesome. Yeah, you jumped right in. I love it. All right, Tim, you're next. So Tim he got his MBA at Wharton. Not ideal, but here you are. And then he spent a bit of time doing investment banking and then private equity. And now he is doing investing into different platforms for crypto under a digital currency group. Tim, why don't you tell us a bit how you got into crypto?
Yeah, sure thing. So it was actually during my undergraduate studies at Cambridge. I saw it mentioned on an online forum and thought I would try it out. There wasn't really an easy way to buy it, so I had to wire money to Slovenia, which is the bank account for Bitstamp at the time. Took about 2 weeks to arrive, so that was pretty nerve-wracking. And then when it arrived, it was quite easy to buy Bitcoin. And then I had like this paper wallet with like a public QR code and a private QR code, and sent the funds to those pieces of paper until I later, was able to send them to a Coinbase account. So that's how I first got started in crypto.
What year was that?
2013, March 2013.
Got it. Very cool. All right. John Todaro is next. Same alma mater as Tim, University of Pennsylvania. John did a bit of equities trading, bond trading at Citigroup, and now he is the head of research at Needham and Company. John, why don't you tell us a bit more about how you made that switch into crypto?
Yeah, sure. Head of crypto research. Not quite the head of all of research at Needham yet. Maybe someday. I got involved in crypto around the same time Tim did. So in 2013, that was actually one of the early run-ups for Bitcoin was in 2013. So at the time, I actually kind of bought the top of 2013, and then it went into a little bit of a bear correction in 2015, 2014. I was in undergrad at the time. I was at Penn, and it was kind of a confluence of events. My brother was getting involved in it a little bit. At the same time, my roommate was for Silk Road reasons. And so it was a few different things. But for me, what stuck out about Bitcoin was that you did have a hard money asset that couldn't necessarily be censored, restricted, or controlled by any one party or even any government party. And so at the time, I thought that was very interesting, especially because I had some libertarian leanings. So it kind of made sense as kind of that free money there. And then in 2014, I actually ended up getting a little bit involved in Dogecoin for a bit, which was exciting. It was kind of one of the first ones to do memes. Now it's like, obviously meme stocks and meme tokens are a thing, but back then it was really one of the first ones. And then they ended up, I think a lot of people in the community sent money to the Jamaican bobsled team in 2015 with Dogecoin, which was interesting. But yeah, I got started that way. And then, as you mentioned, I went to TradeBlock, which was a crypto startup. I was there for 3.5 years, and we sold the company to actually DCG. So Tim's company there.
Awesome. Love it. And last but not least, our very own Larry Wade from Columbia Business School, representing in the panel. Thanks, Larry. Larry did risk consulting at KPMG, and then now he's the director of risk and compliance at PayPal, focusing specifically on digital currencies and blockchain. Larry, why don't you tell us a bit about your journey?
Yep, and senior director of risk and compliance for our blockchain and crypto digital currencies group. But pleasure to be here. How did I get into crypto? Actually, and he's probably on this line, it was from one of my Columbia Business School classmates. As you'll see, your network is really important. So we would always kind of have dinners. And one dinner, the topic of discussion was Bitcoin. And I'm a credit and a risk guy. And immediately I thought, this is tools. This doesn't make sense. I don't get it. And then he said something that really piqued my interest. He said, Larry, I'm not sure if this is a growth rate. I think it may be an adoption rate. And then the light bulb went off. And then I started to think like, okay, I'm a bit of a nerd. I read a lot of books. I said, wait a second. It's like a brand new asset class that's being traded 24/7. The whole world is adopting it at the same time, and it's global. And it solves this problem of transferring value in the digital age. Once that light bulb went off, that weekend, I read Satoshi's white paper in Blockchain for Dummies, and I've been hooked ever since, which is back in 2017. While I was at KPMG, I built a number of blockchain and crypto-related risk methodologies as well, and just a big nerd in the space. So,
love it. Well, thank you all for being here. And for the audience, I'll give you a brief overview of what the agenda will look like today. And as you have questions, raise your hand, and then we'll get those questions in there. But what we'll be discussing with the panel today is just an overview of what the blockchain trilemma is, the kind of combination of decentralization, security, and scalability. Then we'll get into kind of investing in the space. We'll have some open-ended questions. And then all the panelists will have an opportunity to chat a bit about kind of the hiring needs and where you can have an opportunity as a student to maybe look for a job afterwards. And then we'll end it with a little fun kind of rapid fire type of questions for all the panelists, and then that'll be it. So let's get started. Oh, before I forget, these things in the back, these are the very first NFTs that are created for Columbia Business School. David Alderman, the one that has the other one on the screen, he and Brett and Brandon Hoffman, I don't know if he's here, they were the ones that kind of led the effort on that. But yeah, they're really fun to kind of have them throw in the background. Okay, so let's get started with the blockchain trilemma. John, I'm gonna get started with you. So let's talk a bit about what it means, what the trilemma means, and whether you think this is just something we're just going to have to deal with in terms of optimizing a layer one solution between those three kind of components, or do you think there's just a situation where it's simply a technological impediment today, but in the future we could have a solution that could meet all three things?
Yeah, it's a good question. I think it's something that's not really figured out quite yet. I think there are always going to be some technical limitations. I think a lot of the teams behind different layer ones are making progress on that front. But I think the bigger question is how decentralized do networks need to be, right? Mm-hmm. And so what you have is with some of the traditional payment processors out there is one or a handful of companies can restrict a network and not anyone can tap into it. It's closed source. With the different blockchains that are out there, they are open source. Anyone can build on them. Anyone can tap into them. And if you're decentralized enough to continue to allow that, and then also to make sure there is continued uptime, so if there's not some issue with a server or different areas, the network doesn't go down. That's core. And so that really is, well, how many nodes do you need so that it's decentralized enough so that there's continuous uptime? No one party or a handful of parties can restrict and shut down the network. but at the same time, making sure it's scalable, because if there's just so many nodes online, typically you have reduced scalability. So I think that's the bigger question. And it's interesting because you're seeing it play out with Solana, Avalanche, Ethereum, a few of the other layer ones. And I think a lot of the folks in the Ethereum ecosystem can lean towards what I would almost call decentralization maximalist, where decentralization at all costs. But there is that trade-off. And I think there's going to be some technological improvements that can add on to that. But is there going to be able to have enough throughput even with that is kind of the bigger question. And so instead of coming up with a lot of different technical progress, what you could do is have some fewer nodes that are online. But I think it's still a gray area, and it's not yet figured out what that number is, whether it's a couple thousand nodes, whether it's 5,000 nodes, 10,000 nodes, 100. I think with EOS, I don't know if there's any EOS people on here, so I should be careful, but they had around 20 block producers, and I think that was too little. It did start to look very centralized, but the question is, if you have a couple hundred, or probably you need a little bit more than that, maybe a couple thousand, that might be the sweet spot. But I think we've yet to see that.
Tim, how do you think about that specific component about what John said on decentralization? How, in terms of investing, what do you think about it in terms of its importance on the items that you're looking at?
Yeah, well, I mean, I think in the long term, it is important. The question is what happens between now and when we get there. I mean, if decentralization isn't important, then I don't know what we're doing here. But I think, in the interim, can we have some trade-offs so that we can start developing applications that can handle many thousands of transactions per second, or transactions that are cheap enough for real people to actually use? I think that is an intermediate state that is acceptable. But I think in the long term, if we want people to permissionlessly be able to manage their own finances or own their own data, or do all of these other things that crypto uniquely empowers them to do, I think that decentralization is pretty important.
Got it. Makes sense. Austin, would love to get your view on scalability, right? Solana is famous for its ability to scale fast, and it's famous for its transactions per second metric that Anatoly consistently quotes, and the ability to kind of run the protocol fast and run it cheaply. What are the conversations in Solana Labs, or as you're thinking about building the layer 1 protocol? How are you thinking about the decentralization versus scalability and the importance of each one?
Yeah, so one of the fun things about decentralization is it really depends where you measure it in the stack. So there's a way to measure decentralization, which is the number of full copies of the ledger that exist in the world, right? This is sort of like if you've read the Foundation series, you've seen the Apple TV show, this is the Foundation's approach, right? What's the minimum data that needs to survive an apocalypse in order for you to rebuild the network? And that's one copy of the ledger, right? If you get one copy of the ledger, you can rebuild it from there. There's also the real-time censorship resistance component to it, which is, what are the minimum number of entities that you need to compromise in order to combat the network? This is Balaji kind of claimed this as the Nakamoto coefficient, which is sort of the minimum number of entities you have to compromise to take down a network. For Solana right now, it's 19. That's pretty high compared to other proof of stake networks. That's actually pretty high compared to many proof of work networks. If you look at mining pools across Ethereum, or if you look at mining pools across Bitcoin that have software packages that are managed and upgraded by various groups, the numbers are much smaller than 19. Now, if you look at other levels of centralization, right, you can tell a very different story. There are, there's one kernel for the entire OS layer. It's Linux. So that is, in some ways, you can look at it as a centralization point. There's two hardware platforms that everything runs on. There's Intel and there's AMD. No one's running at scale, or there's ASIC, right? So with decentralization, the question really is not how decentralized is the network in an abstract goal perspective. It's how decentralized in the network based on what you're asking the network to do. With Bitcoin, all you're asking the network to ever do is pretty much nothing, right? Bitcoin is an incredibly simple code base. The point of the code base is it's very mature and it never does anything. There's no smart contracts. It's literally just meant to be a store of value. And so you're asking very different things from the network. In that case, the security of the network comes from the fact that it uses so much energy. And the thermodynamic energy usage of Bitcoin is key to its security. You couldn't have Bitcoin exist if it, if you could conceivably hook up the power grid of New York City and be able to run all the hash power of Bitcoin, the whole point of Bitcoin would be defeated. Part of the security comes from the fact that you can't buy enough electrical generation to attack the network. If you're looking at something like Solana, which is largely an execution network play, it's a very different story there. You're really focused on real-time censorship resistance and the ability to censor transactions at the execution level, as opposed to, impacting the network store of value component. So, with all of this stuff, like, it's very easy to tell a very simplified story about what decentralization is. When you get into the mechanics of why these things matter, it's a much more complicated answer. So with Solana, the goal there is to maximize the real-time censorship resistance of the network. And that is the most number of active nodes that have high bandwidth interconnects that allow transactions to get in and price discovery and market execution to happen across the network.
Got it. Yeah, those different use cases definitely make the case for a multi-chain world. And Larry, would love to get your thoughts a bit on the security piece and kind of build on what Austin was just talking about. Bitcoin has its strength and its weakness tends to come from the same thing, right? It's the fact that people view its consumption as a weakness because of its environmental impacts, but also the fact that it's just so difficult to take control of the network because of all this energy that you need. That's also viewed as a strength, which kind of increases the store of value narrative. How do you think about what the world will look like in terms of what different networks will, in terms of the purposes that they will fill? And how important do you think, do people view security today in terms of what they're looking for in a layer one protocol?
Yeah, that's a great question. So well, first, from the energy perspective, I'm optimistic that crypto is actually going to help move the conversation forward from a renewable energy perspective. Obviously, we're still early days, so I don't want to pine too much, but I do want to put that out there. With regards to security, I couldn't agree with Austin more. I actually believe in the notion of a multi-chain world, and I'd like to think that there will be interoperability protocols similar to TCP/IP. So I am not a maximalist in one chain to rule them all. Also, I believe that utility will win the day. And there'll be different chains that have different utility. Thus, you'll need various ways to actually verify the block. So to Austin's point again, Bitcoin, it's all about security. It's all about that store of value network. So at the end of the day, being secure is more important than being fast. Whereas if you're looking at a smart contract protocol or some type of bridge asset, speed is going to be a little bit more important. So from a minimum viable product perspective, I would say that from a security lens, I'd like to look at, is the project sufficiently decentralized for a particular use case? What is the quality and the level of blockchain development activity? That's important as well, right? You don't want a blockchain where the developers within the community are kind of letting it go stale, because that's not a good thing. Then also just the track record of the blockchain in the community and how quickly things such as outages are remediated, et cetera. So ultimately, it doesn't have to be a one chain rules the world.
Yeah, love that. Makes sense. I'd like to shift the conversation a bit more on the investing front. How do we analyze the different protocols, different tokens, coins, different layer one blockchains? And again, I want to remind, none of this is investment advice, only information purposes. John, would love to get your thoughts on adoption in terms of how we measure it. If we look at some of the kind of big social media companies today, like Facebook, Twitter, and whatnot, they always quote monthly active users, daily active users, right, to kind of talk about the importance of the platform and how it's growing. When you think of like a new layer one or a new solution that's built on top of Ethereum, for example, how do you measure that adoption? And what are some key metrics that you're looking at to determine whether a network is kind of growing or not?
Yeah, I think for L1s, it's going to come down to usage, which a lot of that comes down to, at least for the ones building out decentralized applications, DApp usage. So if you're seeing a number of decentralized exchanges built on the platform, different NFT projects being built on it, borrow lend platforms, any games being built on it, so any decentralized virtual reality worlds being built on it. That's a good measure. So you have to look at a lot of developer interest in building on that platform, and then the actual users on that platform. Like I think, for instance, Binance Smart Chain, there's a lot of projects that build on it, but some of them can just be kind of vampire projects that are ported over from Ethereum. You build on it, nothing really comes of it, and then you move on. So you do want to find real dedicated projects with a solid team that are building different applications, different use cases on it. And so that's a core metric to look at. Then you can look at transactional activity on the layer one. So maybe that's gas fees. So people are actually paying some economic fee to use the platform. That's important to look at. And then when you actually look at the applications built on top of that layer one stack, then you can start to look at, how used is the platform. So you can certainly look at users. You can also look at the on-chain cash flows generated. So some platforms take a fee and it goes to the treasury, others don't, some can be paid out. But if you're kind of analyzing from an investment perspective, you can start to build typical valuation models, you guys are probably doing in different classes or had prior work experience with. You can start to do that to some crypto protocols, right? And so I think like SushiSwap's a good example of one. Is a very obvious case is there's protocol on-chain fees that are generated to use this platform. People are paying that to use it. And then you can go stake that asset and earn some of those, either in a buyback and burn schema, or you could envision some just effectively being paid out like dividends. There's obviously some regulation around that. So I think a lot of protocols want to make sure they're on the right side of that. But you can start to see how these have real economic use cases, real cash flows, if you will, and kind of start to build traditional valuation models on the back of that. Layer ones in terms that are going to be a little bit different. Once again, it's going to come down more so to gas usage, developer interest in building on the platform, supply and demand as well. So if there's a large lockup for whatever reason that needs to be, that can also drive pricing pressures as well.
Just to follow up, have you seen that in practice when people are just taking a look at, say, a DEX and they're modeling out cash flows, discounting it back to the present, and then giving you an enterprise value for it?
I've done that, and some people have done it. So I was on Bankless, which is the Ethereum one. This was actually before I joined Needham. I put out a SushiSwap model. I used a DCF. You can throw a
that's awesome
rate on it. Yeah, it's unique, and other people started doing that as well. Though now you have a few other folks out there. We don't do that at Needham, and I don't know of any sell-side bank that's done a report quite like that yet. But you do see some crypto entrepreneurs and investors on their own putting some of those out there. So I'm starting to see a few other ones.
Tim, would love your thoughts. How do you go about your valuation?
Yeah, I mean, it's interesting. The market hasn't really coalesced around any sort of standard valuation metrics like you see in traditional markets. But as John mentioned, a lot of these protocols are revenue generating, and you can figure out price earnings multiples and start comparing that to things that you might see in traditional markets. If there's a storage network, maybe you're looking at the cost of storage. How much does it cost to store a terabyte on this network versus AWS or whatever. Obviously, storing stuff in a decentralized manner can sometimes be more expensive. You're storing multiple copies. You're ensuring everything is available at all points in time. So that's some ways that you can do it. And I think there's a lot of on-chain activity that's quite important to monitor as well. Number of transactions, number of people who are staking. One of the amazing things about blockchains is that you have full visibility into everything that's happening. And so if you're using a tool like Gene Analytics or an Anson, you can get pretty detailed and you can construct your own queries and figure out what's going on. Just to give you an example of that, in Decentralized, you've got the entire history of every sale and purchase of every single parcel of land in an economy, in a metaverse. Where else is that true? I think there's a ton of information. You just need to, figure out ways to start analyzing it.
Yeah, I love that. The transparency is mind-boggling. I remember when David and I first met, one of the first things that I did is just go find out what was in his wallet, and that was hilarious. But I wanted to talk a bit more in terms of the investment process, right? There was a piece that Bank of America wrote not too long ago. They published it maybe 3 or 4 months ago. And they mentioned there are 3 ways in terms of how you look at the investing in a coin or a token. It's adoption, it's functionality, and then development. We talked a bit about the adoption. When we think of functionality, a lot of people, naysayers, will say, look, if you have a hammer, everything looks like a nail, meaning you have the solution that you've built, then you think that you can solve the world's problems with it. However, other people think of the possibilities that go beyond just what's there today. So when we think of functionality of a token, right? Tim, I'd love to get your thoughts again, how you think about comparing that to what already exists and the true innovation behind what's happening.
Sure. Well, I guess the first point I'll make is that, and this is an idea that Chris Dixon talks about a lot, is that you kind of have 2 phases whenever you have a new wave of technology. You have the skeuomorphic phase, which is where people tend to copy some of the previous solutions that existed, in the previous paradigm. And then going beyond that, you have, I'm sure he's got a better word for it, but I'm just going to say non-skeuomorphic, which is where, you discover that actually this new technology allows use cases that weren't even really possible before. So when thinking about functionality, does everything look like a nail? I'm not sure that that's true. I think, as it relates to Web3, there are a lot of use cases that were just not possible before, i.e., for example, a completely censorship-resistant social network, or financial privacy that's provided by some protocols, or the ability to trustlessly and permissionlessly, exchange your assets. I think these are all, just things that weren't really possible in the previous paradigm. So I don't know, does that begin to answer the question?
Yeah, no, that's perfect. It reminded me of what you talked about, Alexis Ohanian of 776 and Reddit, obviously. He talked about he cannot wait until people stop thinking, let's make this a Web2 thing, a Web3 thing, and start thinking, let's make a Web3 thing, right? That doesn't have the Web2 thing already there. So that's what you mentioned about Chris Dixon, which is very interesting. Austin, would love to get your thoughts around development, that third piece of kind of the investing in the space. What are you seeing at Solana? What are people focusing on in terms of building? I know you have a bunch of like DEXs, there's different applications that are being built. You have Michael Jordan coming on board, talking about NFTs and connecting athletes directly to consumers. What are you seeing on the space, and what are you most excited about?
Yeah, so one of the things I love about the valuation conversation is it's very much trying to force a model to a technology that I don't think really makes much sense. It's sort of like looking at every business that uses any form of technology and trying to say there's one VC model that's going to help you evaluate Theranos and Shopify. Like they're fundamentally different businesses working in incredibly different spaces and trying to come up with one sort of thesis for how you value something in blockchain. No one looks at BlackRock and says like, oh, what's their daily active users, right? Because that's not a metric that anyone feels like is a particularly valuable metric when you're looking at a company like that. But it may be an incredibly valuable metric when you're trying to value a social network or something like that. And I think a lot of the consumer-facing VCs, which are now investing in blockchain, because parts of blockchain are very consumer facing, they're dragging a lot of these legacy metrics through. Daily active users only matter if your goal is to sell ads. And the goal in Web3 is very much not ever to sell ads, right? Daily active users has no impact on a company's revenue unless monetized minutes in front of a screen is the metric that's your key business driver there. So that's kind of just one piece before we kind of get into some of the other stuff. But in terms of what's actually being built on Solana today, it's a combination of what I'd say is like strong, like fundamentals that are often called primitives, but would just be called like, the Lego building blocks of DeFi or other sorts of applications, right? So Serum is an on-chain central limit order book, which is the same order book model that like the NYSE or the Chicago Mercantile Exchange uses. These are very different order book structures than like an AMM, which is something like what Uniswap uses. They give you a much more centralized style experience and access to liquidity. And then What's really nice about Solana is because it has this concept of program reusability and composability, all the different DeFi applications on Solana are able to tie into the liquidity pools that are built on Serum or use Serum's permissionless pools to deliver some other kind of user experience out of that application. So what we're really seeing is like engineers doing exactly what they do in the Web 2 world, building on top of other products, extending the functionality of other products and services, but doing it in this fully decentralized, permissionless way. And we're seeing a lot of the developers who are coming over are actually not coming over from Ethereum or, you know, one of those legacy layer 1 blockchains. A lot of them are coming from a Web 2 world where they're used to bandwidth being readily available. They're used to transactions being readily available. And so that mental model of saying like, I have to get used to building in decentralization, that's a jump. A lot of people have to handle that from a web dev perspective. But to also say, you know, the beauty of Ethereum development is transactions are hyper optimized, right? It's like programming for like a 16-bit flip phone. You have to be incredibly specific in what you want to do with a transaction and make your code as efficient as possible. You look at like the modern mobile world, everyone just builds iPhone apps in Swift, not because Swift is the best language in the world, but because iPhones are powerful enough. It doesn't really matter if you're sacrificing 10 or 5% performance gains because the underlying hardware is so powerful that it doesn't really matter nowadays. That same model is really what's happening with Solana. You're seeing a transition from a world where transactions are very expensive, very scarce resources to a world where transactions are very cheap and very abundant. And this is not like just a Solana. I mean, it is just a Solana phenomenon right now, but it's not going to be. The goal of ETH2 is also to make transactions much more abundant and much, much, much cheaper. So this is really like a shift in the development paradigm. I think because of Solana's network dynamics, it's a bit ahead of the curve here, but we're going to see it get easier and easier for developers who are used to a Web 2 world or used to a non-compute limited world be able to start building on blockchains much more efficiently over the next maybe 3 years.
Before I give Tim, John, and Larry an opportunity to give me their thoughts on some of the most interesting projects I've seen recently, I wanted to just make a couple comments about what you just said. First, the fact that Ethereum is already considered a legacy layer 1 solution is hilarious. And then secondly, you made a pretty insightful comment earlier in the very beginning of what you just talked about, which is just because some solutions are being built on top of the same chain does not necessarily mean that we should value them using the same metrics, right? A DeFi solution is totally different than like a social media kind of protocol. So those are totally very different. That makes total sense. Larry, John, or Tim, do you guys want to add anything about in terms of development, some interesting things that you've seen recently that have an opportunity to kind of get off from here?
Yeah, I would say that something that's really kind of near and dear to my heart, just being again a credit person, is just this notion of tokenization of illiquid assets, and then moving that to a world of interoperability, where now all of a sudden you can imagine walking in and let's say you have your wallet and you can say, I want to utilize 1/100th of my Tesla stock to purchase my groceries at Whole Foods. Again, crazy thought, but we're just moving to this world of assets that are currently either kind of boxed off from a certain investor class will now have more access to just the everyday investor, and then also just the notion of being able to have instant settlement, fractional ownership, and then just real-time markets that are worldwide and travel 24/7. That really excites me.
Love that.
Yeah, I would add just what's really exciting about all this different technology is the speed with which you can build a full stack onto something, right? And that's because it's all open source, so anyone can tap in. So in the traditional world, maybe JP Morgan would work on something. No one really knew what they were working on. They would build on it and maybe nothing would come of it, or maybe something would. But now you have it, whether it's Ethereum, Solana, Avalanche, any layer 1, you have that getting built out. Then say someone builds a DEX on top of that. Then someone builds a yield aggregator on top of that. And then a borrow lend. And before you know, you have a full service of financial products built in this manner that's very quick. They're all integrated and interoperable with each other. So I think that's one of the key selling points of blockchain technology and why it's so exciting.
I'll just throw in a quote there, and I can't remember who said it. It may also be Chris Dixon. Chris Dixon's got a lot of good crypto quotes, but what he said is composability is to open source software as compound interest is to finance, i.e., the ability for people to build on top of it. It just has this sort of snowballing effect where these entire ecosystems get built, as John said, in an incredibly short amount of time because everyone's building on top of everyone else. It's all open source and permissionless. And in the same way that, whatever, 3% interest over, 50 years grows to something pretty enormous, you're seeing the same thing in crypto.
Wow, that's huge. I love that quote. And being at Columbia Business School and any investing class I take, so in one class, we literally had to say compound interest 8 times in a row as a class because it's the 8th wonder of the world. That's just, it was funny. I want to ask a couple of open-ended questions, and anybody in the audience that has a question they want to ask, just raise your hand, and then we'll I'll throw them in there with the questions that I have prepared here already. But Tim, let's get started with you. In your job, right? You invest in various solutions that are available with over 12,000 coins and tokens. How do you go about your research process? Where do you start?
Sure. Well, one of the first things we can do is discard a pretty large number of those 12,000. But in all seriousness, I think we think about components of the Web3 stack. That can be a good place to start. I mean, there are different ways to answer this question, I guess. You could look at different layers of the Web3 stack, and you could invest in the layers and the protocols that are going to see increased usage as more and more developers move. And there's an interesting metric, like there are 16,000 Web3 developers, which is an absolutely tiny metric out there. Tiny metric. There was a report that Electric Capital put out recently showing the sort of trends of the number of Web3 developers out there. I'd encourage people to download it and take a look at it. It's pretty astonishing how early we are, even though it may not seem that that's the case. But yeah, so I think investing in layers of the stack that are going to see increased usage over time can be an interesting way to do things. I think one of the things that Austin mentioned earlier actually is quite interesting. What are the primitives that we're going to see being built, on different layer ones? Take an example, Near is, is there a borrowing lending marketplace on Near? If not, let's find the team that's doing that, or let's spin that up in-house. And that's something that we've done at DCG as well. Actually, one that we did on Solana very recently was we invested in Hubble Protocol, which is a state that they're issuing their own stablecoin on Solana. They have a borrowing lending marketplace, and they've got structured products and unsecured or under collateralized rather lending, that they're going to be rolling out in the future as well. We saw that as, a pretty clear primitive that, there is some competition on Solana, but not all that much. And that made, a lot of sense for us. And then in terms of other things that we can consider when choosing what to invest in, it's what we discussed earlier about a lot of the metrics, both on-chain and off-chain metrics, and those play a part as well.
Got it. Austin, I'd like to move a bit on and talk a bit more about some of these decentralized exchanges that are being built on Solana and just other sources as well. So we have Serum, you mentioned earlier, on Solana. You have SushiSwap and Uniswap, also sort of decentralized exchange, but an automated money or an AMM. When we think about these decentralized exchanges and then compare them to the centralized exchanges of the world, Coinbase, Binance, FTX, right, that have literally been printing money for the past 10 years. It's just been incredible, the fees that they charge and the money they're able to take. The margins are huge. How do we think of the world in the future? Do you see a world where you have centralized exchanges and DEXs kind of live together? Or do you think one of them will kind of overpower the other in the future?
I think it really depends if we ever get a CBDC. And that's the central bank digital currency.
Yep.
This would basically be an equivalent of USDC, except issued by the Federal Reserve, or pick your bank in the world. Until we get, look, payments and banking in the US is a hot mess. Everything still runs on ACH, which is subsidized by the Fed. Even Zelle runs on ACH, which is subsidized by the Fed. It takes a very long time for stuff to clear. Money only moves during certain arbitrary hours of the day. Like, this is a major problem for large banks. Like, there are hundreds of millions of dollars of wire transfers that shoot around 9 a.m. Monday morning to meet collateralization requirements for credit card processors by various people. Like, the system we have is like very broken, and in other countries this doesn't exist, but because everything's built on the Fed rails in the US, this is like a real nightmare for like not even just people in crypto, right? Like banks, merchants, processors, the whole 9 yards. So the real answer here is like the centralized exchange has a very strong role right now, which is that it's onboarding, right? There's no real other way for me to get crypto besides like meeting someone and handing them a bunch of cash. And most people aren't going to do something like that, right? So you really do need some sort of entity that's connected into the banking system. I would love if Uniswap had a bank connector, but like realistically, I think we're probably 5 years away from any DeFi apps feeling like they are mature enough and built out enough that they want to actually build in like ACH wire transfers, ACH or wire transfer into their applications. That's still very much served at the centralized exchange level. Now, if the Fed comes out and decides, actually, we're going to do a CBDC, like a few European banks are experimenting with, China's been experimenting with this for a little while as well. That changes everything, because suddenly, presumably, it's run on some sort of a blockchain, or there's an export out to some sort of a blockchain, and then it just becomes a token swap, just like anyone else. Even if you have to go through KYC and AML, and you have to prove your identity, like the on-ramp and off-ramp are the hardest parts of the crypto experience right now. And that is where the centralized exchanges thrive.
Mm-hmm.
Does that last forever? I don't know. Like Coinbase's real growth rate, if you look at the S1, their actual growth rate in the year before their S1 was 0.1%. No one realizes that because the assets all went up by 400%. So it looks like their revenues through the roof, but their actual true growth rate was 0.1%. Now, I think you look at their quarterly earnings since then, it's higher than that. But that is kind of the thing that you're looking at here, where a lot of the new users onboarding, they're not necessarily going through a centralized exchange, or they're going through the centralized exchange to turn their US dollars into USDC or USDT. And then they're going off into the great world of DEXs and DeFi ecosystem and doing all the fun stuff there.
Right. Yeah. That makes, you could always, if you want to, you can skip the centralized exchanges and just send money to Slovenia, what Tim did, and then you're set. You've entered.
Well, I was actually sending it to a centralized exchange. I was sending it to Bitstamp. It's just
right.
At the time, it just took 2 weeks at the time, and the bank charged me 2% to convert the pounds to euros, and I was freaking out for a full 14 days before the money arrived, and it was just a random account number as well. Anyway,
I mean, look, wire transfers don't even have a return address, so like it literally is just sending money into nowhere, and you can look up some great horror stories of people whose banks outsourced it to the lowest transfer agent, and you can trace the wire transfer like bouncing around 45 countries before it finally ends up where it's supposed to go. Like this whole system is like, it's amazing the global financial market works.
Wonderful. Yeah. In terms of CBDCs, I'd like us to spend a bit more time there. It seems to me that it is in the Fed's interest to build CBDC. Otherwise, you would have this entire ecosystem, like you mentioned, Austin. You get on the Web3 ramp using kind of the centralized exchange, and then you're doing your own thing. However, if the CBDC exists, the federal government, the Fed, would have a bit more transparency as to what people are doing, which may be in the government's interest. So assuming that that's going to happen, that the government will kind of work on its own interest, how do we think then that will change the world of crypto?
So I don't know if we're going to get CBDCs that are user-facing. I think a lot of people assume that a CBDC is going to look very much like USDC, because that's a very obvious answer for everyone to come up with. But like historically, the Fed likes to deal with no one except a very few small number of banks. And their charter is actually pretty strict in terms of what they're allowed to do. This is, a lot of people give them rightfully a lot of, we can swear on this, yeah, it's a Zoom, a lot of shit for not bailing out homeowners in 2008 and 9. But like they really weren't able to do that the way that the institution is set up. But instead they had to indirectly bail out homeowners by bailing out banks. And like, I think that's a bad system. I think we should change that system, but also like that's something that involves Congress, and good luck. So, you know, it might be that a CBDC is very similar to the way that Circle actually does things right now, where Circle lets a few entities mint USDC. And those entities then have to send a wire transfer back to Circle to sort of say, oh, I minted $10 million. Here's a $10 million wire transfer. You could see a CBDC working in a similar way, where you're really just building a very heavily permissioned bank to financial institution CBDC exchange layer, where money moves as fast as it does on blockchain, but it's a very tightly controlled network, and it's not actually open, and it's not a competitor to PayPal or Visa or anyone like that.
Yeah, and just to Austin's point, I mean, the CBDC, I'm not necessarily sure that's going to be consumer facing. I agree. I think that you're more likely to see stable coins that are pure one-to-one, where it's not only, so obviously, you know, with Facebook launch, you know, that was a basket of currencies, that's something different. But then you'll have more like a cash and cash-like equivalents, right? I think in the beginning, from institutions that obviously have some type of federal and or state oversight, you know, BFS, et cetera, you'll probably see more stable coins that are really one-to-one. And then now if you have a one-to-one where it's $1 for one stable coin, and it's with a trusted institution, right, still on an open source blockchain, now that could also be an entrance into the DeFi space and those other types of exchanges as well.
John?
Yeah, I would just add what's always interesting to me is people think, oh, you know, crypto is a competitive threat to the dollar, but with the growth in USDC, it's actually stablecoins are kind of the de facto, you know, currency in the crypto ecosystem, right? I think a lot of people would look at Bitcoin and think it's more of digital gold. And so what a lot of users are settling on is actually stable coins, which for the most part are backed by cash or cash equivalents. That is actually being utilized in the crypto ecosystem. So, you know, it's not like people all settled on, oh, we'll use Ethereum as payment for all these different dApps. It's, you know, mostly USDC. There's now 40 billion plus in it out there. Tether, who knows how much that's back, but that one's got, you know, 50, 60 billion plus as well. So it's interesting how the dollar was able to make its way on chain actually and be utilized in a lot of different applications.
Yeah, I want to just challenge that a little bit, because a lot of the times being in the United States and a lot of us working in financial industries, we're a little bit clouded to the global perspective on some of this stuff. If you look at like crypto companies or even a lot of mainstream companies operating in somewhere like Ukraine, they self-custody 99% of their assets on blockchain in some fashion or another. You look at Eastern Europe and it's one of the highest penetrations of crypto of anywhere in the world, because they don't have faith in their currency. They don't have faith in their banking system. And they have a reasonable expectation they may have to pick up and leave. And it's really nice to be able to carry a ledger with you as opposed to having to go to the bank first and try and rely on that system. So I think we have an assumption in the US, this is like a cultural problem at a very macro level, that we think the way things are is the way things are going to remain. And it's very easy, like the US dollar is still the reserve currency of the world. That is not a position that is in any way guaranteed any more than the US Navy is the most powerful Navy in the world, and that the US military can win any war it goes into, right? All of these are like positions that we sort of assume exist. And US, you know, stable coins have been a massive boon to the US dollar. They're the preferred settlement layer for almost everything in crypto. But as crypto matures and as the asset prices become less volatile, you may see something like ETH replacing LIBOR for the DeFi ecosystem in the world. I'd be very curious to see if that happens, right? Or it could be something more stable that comes up that's based on a more global pool of different currencies. It averages out to something that's almost like a world stable coin. So I just, you know, I have lots of things in stable coins. I think they're awesome, but like, it's good to keep in mind that a lot of this stuff is not necessarily as solid as we think it is.
That's so interesting. It sounds like you guys there at Solana have a pretty tight-knit culture, because Anatoly also talks about the power of self-custody and the the true value of crypto would be unlocked once you get self-custody become a more prominent portion of it. Because even today, when people are investing and they have like coins, they're sitting on Coinbase or whatever kind of centralized exchange there is. They're not really doing self-custody. But speaking on that, I would love to get the panel's thoughts, and whoever wants to can chime in. There are obvious benefits to self-custody. Austin just mentioned them, but there's also drawbacks, right? You can lose your key. It happened before and continuously will happen again, probably. And it's very difficult to kind of, it sounds great in theory to have ownership and rights to exactly where your own assets are, but there are risks involved with it. Once you lose it, you're done. Whereas if you go to the bank and the bank is the custodian of your assets, then all they need to do, they'll obviously hold it for you. They'll verify who you are and they'll give you access, right? But how do we think about that trade-off between the benefit of having self-custody and the risks that are involved with doing it yourself?
Yeah, I mean, it's interesting. So I self-custody, and I also obviously use PayPal and Coinbase as well. I think it goes back to this notion of it doesn't have to be zero sum, right? There are certain individuals that feel a lot more comfortable having something in the wallet of a trusted institution, and as long as they feel they have access to it, and maybe they have some type of whether insurance or some way to indemnify them if it's lost, that means something to them. There are other people who say, all right, I really want, not my keys, not my crypto. And I think there's a world for both. Some people might want to buy a gold ETF, and others want to actually hold the gold bar. So I don't necessarily think it has to be zero sum. I do think it's important for individuals to have the optionality, and that's also where we're moving to, because right now we don't necessarily have the option. If you're in a country and the government is based on your currency, can you really get on a plane with a bunch of gold bars? No, we get on with the nano ledger X or a nano ledger X. So again, it doesn't have to be zero sum. I think there's going to be a place for both within the world.
I would just add to that you may think that your coins are safe on an exchange. That's not always the case. So I'll just put that point out there as well. There are plenty of I narrowly avoided the Mt. Gox hack in 2015.
Absolutely.
Thankfully. But and I also don't think that self-custody is necessarily as difficult as people make it out to be. I think you're starting to see it, and Vitalik talks about this a fair bunch, social recovery wallets, a bit like Argent, for example. This is where you can have sort of friends who protect your account. And so in the event that, you lose your phone or whatever, you can have, a certain number, maybe it's 3 out of 5 friends, verify that it's you, and your wallet will restore itself. Or you can do things like splitting your key into 5 pieces, 3 of which you need to recreate your wallet. And so even if you lose, if one of them burns down and another piece gets stolen, you're still good. And for what it's worth, I also self-custody the vast majority of my crypto assets.
Very cool. Yeah, there's I think Casa is another one of those solutions that allows you to have the 5 different places where you can have your keys. Okay, I know we're
Austin, just one quick thing too on the exchanges. I agree with you. I was specifically speaking more from a PayPal lens, similar to your PayPal balance, where there's a level of protection. So I absolutely agree with you on the exchanges, but I just think that certain companies are going to be able to offer a different user experience as we continue to mature.
Yeah. I want to give the panelists an opportunity to talk a bit about either you can talk about advice that you have for the 70+ participants on the call in terms of how they think about the future and entering the crypto native space. And I'd also like to talk specifically about opportunities you have your own individual firms and how students can get involved there. And as the panelists are kind of giving those pieces of information, we'll have maybe students can take a moment and think about the questions they want to ask. Otherwise, we'll just go to the rapid fire questions in the end and then close it out. Why don't we start with Austin, because you're at the top of my screen.
Sure. So jobs.solana.com, that's the community job board where anyone who's building something on Solana can go ahead and post jobs to this board. It's one of many places. Highly recommend checking it out. There's about 180 jobs listed there right now across many different disciplines. In terms of advice for people coming out, like I studied political science and environmental studies undergraduate, right? Like getting into this space is so much easier than you think it is. My biggest advice is go work for an actual blockchain company to start out. You can always go and work for a bank. You can always go and work for a VC firm. You can always go and work for an investment firm. But like the first jobs you have define a lot of your capabilities for the rest of your career. And the most successful, even if you want to go work for a VC, the most successful VCs, they have a deep technical understanding of what they're doing and what's being built and what those applications are. And the best way to learn that is to actually go work for a blockchain company, go work for someone who's actually building stuff on chain. That can be an infrastructure company, or it can be an actual DApp, or it can be a layer 1 or a layer 2. But really, it's just about like getting your brain into that mode and understanding what that's like, right? You're only young once, right? It gets harder to do this stuff the older you get. Your risk tolerance goes down no matter what you might think. So I would just be very cautious about just jumping right into a job at Goldman or something like that. If you're interested at all in crypto, like this is the time to try it out. And all of those other jobs will be waiting for you if you decide that's the right thing in a year or two.
Yeah, I totally agree with Austin. I mean, this is one of those once in a lifetime moments where we are living through an actual paradigm shift. So I actually think it's irresponsible not to become familiar with blockchain and crypto technology, and also just to explore all of your options. You know, one piece of advice I would give, just because obviously I do hiring and things of that nature, is don't discount your prior experience and the current experience that you have. Because at the end of the day, institutions can be a bit risk averse, right? So if you can say, hey, my prior experience is X, and I'm now able to not only adapt that to this thriving new ecosystem, I can also help you scale the traditional world with where the new world may be going. That's very appealing. You know, from our perspective, we have crypto positions in finance and business development, product, obviously engineering, risk. So don't discount what you've done in the past. Really utilize that as a competitive advantage to move to this amazing new world that we're in.
Yeah, I would say my perspective might be a little bit different because I am at a bank right now. But what I would say, you know, I think what is exciting if I'm going to do the banking push here is to be in a position where you can kind of mold where that traditional Wall Street world is going in crypto. And so joining a crypto group or a crypto division at an investment bank is really interesting, where you're given that opportunity to mold that. You know, in regards to just working kind of maybe a traditional investment banking or equity research or sales and trading role, you know, I don't, you know, it's certainly going to not be as exciting. I used to do that back in the day, and working in a crypto group is certainly way more exciting than I think a lot of those traditional financial products can be. And it's also, you know, kind of where the puck is going, skate to where the puck is going. But being in a position to shape where that traditional world is going in crypto, I think is certainly an exciting area. And in terms of jobs, we're hiring actively in crypto for research, as well as crypto investment banking. That's not really on the token side, it's more on the equity side of things, but obviously there's a lot of M&A capital raising going on for traditional crypto companies like Coinbase and whatnot. So we are hiring in that area as well.
Cool. So a couple of pieces of advice. I think, you know, it's still the case that most people in crypto are very open and receptive to inbounds. So do not feel, you know, afraid to reach out to people and ask questions. Everyone's here to help. Second piece of advice is that I would say that I think crypto is sufficiently de-risked now. And I think it's possible to have a career where you're just solely betting on the future of the digitalization of everything. You know, I think you can build a career on that. And I think that the opposite is very unlikely to be the case. You know, that this isn't going to transpire in some shape or form. So I would say that, you know, consider that, you know, this is very likely going to happen in some shape or form. It's extremely exciting. It's at the nexus of all types of different, you know, fields. And, you know, I've never had a job that's so much fun, let me put it that way. In terms of DCG, you know, we're investing in tokens, we're investing in venture capital at both the early and the late stage. We're investing in public companies that are crypto businesses. And we're also investing in crypto funds. We manage about $4 billion with a pretty lean team of about 10. We're looking to triple that over the course of this year. So I posted the link to our jobs board. That's also got jobs at some of our portfolio companies. But yeah, feel free to apply or reach out to me or what have you.
Awesome, that was great. Thank you all. If there are no questions from students, we'll end it with a few rapid fire questions, and we'll go in reverse order this time. So we'll go Tim first, John second, Larry, and then Austin. So I'll go ahead and ask the first question, and then if it's a one-word answer, cool, a couple words, whatever, just whatever the answer is that you want to give. First question, should Sam Bankman-Fried get a haircut?
Yes, and I should as well.
John?
Yeah, I mean, I think he's down in the Bahamas now, so yeah, you can get a haircut, get some of that sun through for him. That'd be good. Yeah, get a tan going as well, I would tell him.
I'm gonna say no. I think it's part of his brand now, so he can get away with some interesting things.
Just do what he wants.
Love it. Give me, with a few words, the most exciting Web3 use case that you're looking forward to the most.
Genuine decentralized social networks.
Maybe, something metaverse out there, not too gimmicky, but something decentralized, virtual reality world that's actually playable and fun would be interesting.
The idea of the super wallet, where there are tokenized assets, both fiat, et cetera, all operating as one, and being able to kind of pick and choose.
I think the concept of crypto can fix a lot of US politics. That the idea of self-custody puts you in an ownership position and an active position as opposed to a reactionary position. And that this is very kind of like Ta-Nehisi Coates, policy creates racism, racism doesn't create policy. You can flip the same thing and say the mentality change that you have to go through to join blockchain, I think can do a lot to heal politics in the country.
I love that. It's a very positive note. Alexis Ohanian is investing heavily in L2 projects that are built on Solana. What's the primary risk that he should be considering? Tim first.
We're also investors in a number of projects building on Solana. I would just say making sure that he's got a diversified strategy, across the applications and across L1s and L2s. That would be my advice.
Yeah, I would say, I'm a big fan of Solana. Full transparency. Bought it early on. I think it was around $1. It's a great protocol. Solid team behind it. So I think it's great. But yeah, do your due diligence. Make sure, especially the projects that are building on it are solid, good team behind it, and all that. But yeah, it's great to see that.
Yeah, I would say regulatory risk, just given that landscape is continuously evolving, and it's also very just region specific. Really keeping an eye on that.
Yeah, I thought this one was interesting because there aren't really any L2s on Solana. Neon Labs is probably the only one I can think of. The real risk is that the Solana thesis doesn't work. That the one single global state machine doesn't end up working out at a certain level of scale, because the point of a layer 2 is that you're offloading computation and transaction workload from the L1. Solana doesn't really have any offloading. 99.99% of the offloading is still actually on chain. Even when Serum runs a crank, it's not a proper L2 or something like that. So I think it's really if that scalability somehow doesn't actually deliver in production, that's the risk there.
Cool. Columbia Business School, at least, are the people here that are part of blockchain and crypto. We're thinking of launching a DAO, and for a couple goals. First, kind of keep our community alive even after we graduate, and also do that by having a bit of skin in the game. What's your advice? Tim first.
Okay, make sure it's set up properly, especially if you want to do any investment activities. Keep it fun. And the third one I'd say is not everyone needs to vote on everything. Maybe think about delegation or, representative democracy, or what have you. Just have a bit of a think about exactly how you want to structure it, because it's not necessarily the case that everyone needs to weigh in on every single decision.
Yeah, I would add, you know, DAOs certainly have some regulatory hair on them, so maybe get the law school involved as well in any endeavors. But yeah, you know, be mindful of regulation and understand that component. And make sure it's useful. You know, I think a lot of them, it's kind of a buzzword now, so people just want to go do them. But make sure there's actually some purpose and point behind it.
Yeah, and once you have it set up correctly and all the good legal and regulatory considerations have been thought of, you know, kind of treat it like VC, right? With what you're looking at, you know, really, yeah, look at, you know, the team and the use case and the potential market and, you know, the scalability. You know, really have fun with it and utilize the qualitative factors as well as just the traditional quantitative factors that we learned in school.
Yeah, I mean, a lot of what John said, like make sure you're starting with a problem as opposed to starting with a cool piece of tech. DAOs are awesome, but you know, how good does your student government work, right? If that's not operating the way you want it to work, it's probably not going to translate well to a DAO or your alumni association or anything like that.
Makes total sense. Bitcoin to 100K, yes or no?
Yes.
Yeah, you got to say yes. Yes, of course.
Yeah, absolutely.
I mean, just based purely on inflation.
I like that. Ethereum is expected to transition to proof of stake. Will this happen before or after 2023? Over, under?
Before the end of 2023.
Oh, I don't know. It's been keep getting pushed out. Maybe I'll take a contra position here and say no further out.
Yeah, I'm with John on that one.
I don't think we'll see more activity on whatever is live in ETH2 in January of 2024 than we'll see on the ETH layer 1 chain in January of 2024.
I don't know what that means.
ETH2 is not going to overtake ETH1, even if it does launch as scheduled before January 2024.
Option C, I like it. And then finally, I feel like I know this one for Tim, but your favorite crypto person?
I'll surprise you then. Kobe, I think he's great. He's just like, yeah, he's just hilarious. You can never not have fun reading his tweets.
Yeah, that's a good one. I would say Arthur Hayes. He actually put out a pretty interesting note lately. I think his writing style is really unique and kind of fun. So he's a good guy to follow.
I'd say David Schwartz, the CTO of Ripple. I think he's brilliant, and I just really love seeing reading about his insights.
It's a tough one. You know, Armani, who created Anchor and works for FTX, I think he's got some of the best insights into like the practical, tangible things that are happening. But like, just to go back, like Chris Dixon still, you know, for a high level overview for the things that you really need to think deeply about, like his infrequent writings on this stuff is quite good.
Awesome. Love it. It's a great note to end on. That's it. We've taken more of your time than what I initially thought, but thank you, four of you, so much for taking the time. This was very fun for me, and I think for the rest of the students. So I think hopefully next time we bring you guys on campus, you're here in person, and hopefully we'll wine and dine you a bit too, so we can have a little more fun afterwards.
Awesome.
Thanks
so
for having
much.
us.
Awesome.
Thanks,
Cool.
everyone.
Thank you guys. Have a good one. Bye-bye.